Geoff,
And you're muted. No,
can't hear you. No, can't hear you, Geoff.
Let's try that again.
yeah, we
Oh, there
can.
you go. We can hear you now.
Thank you. There, I was trying to be polite and cut down the background noise because the fairy doorbell was going crazy for Amazon. Anyway, this is the third in the series of planning. So a couple of weeks ago, we looked at how to finish this calendar year strong. Last week, we were looking at how to plan this current financial year in Australia. And today, I'm going to look at what is probably the single most important tool you've got. It sounds boring. It takes a bit of grunt work, but it's really vitally important to you and your business. So today's about a no BS guide to building a 13-week cash flow projection. And you can do this even if your books are behind, you hate spreadsheets, or your idea of financial planning is checking that your bank balance is still there every morning. I'm not going to go through who I am. You should all know me by now, but you're in good hands. Questions, please have some questions at the end. If there's no questions at the end, I'll do my usual bounce around the breakout rooms and answer any questions in a slightly smaller context if you like. But look, let's be honest with each other. I've worked with hundreds of business owners the last 12 years. Smart people, experienced people, people running $100,000 businesses to $10 million, 15 or even $40 million businesses. And almost every single one of them at some point has been flying financially blind. They check the bank every morning like it's their weather report. You know, the money there, it's a great day. Money's tight, I'm in panic, right? Does that sound familiar? Because that's what most small business people in particular do. Here's the problem with that approach. It tells you where you are. It doesn't tell you about where you're going. A cash flow forecast will help you understand what's coming and to plan for it. Cash flow problems are the number one reason that businesses fail. You can have a profitable business, but if you don't have cash to pay your bills when they're due, you go out backwards. And there's been hundreds of profitable businesses go out because their cash flow was lousy. It's not a lack of revenue, but it's a lack of visibility over how your money's moving that brings businesses down. Looking at it through a cash flow forecast isn't complicated, and it's something we can do. And it doesn't even require your perfect books, as I said before. What it does require is probably about 90 minutes to set it up, and then 15 to 20 minutes a week thereafter to keep it up to date. So what is a 13-week cash flow projection? It's exactly that. It is a projection forward of the cash that's coming in and out of your business over the next 13 weeks, which covers 3 months. Simply put, it's a week-by-week snapshot of the money coming in and going out of your business. Think of it like a financial GPS. It's not just where I am now, but where am I headed and am I going to run out of charge before I get there? It's the single most operationally important financial model that you can use. Your accountants will tell you it's the P&L. That's a historical document. That told you what happened. It's not telling you what's likely to happen in the future. That's what this does. It's not a 5-year plan. It's simply a rolling forecast for 13 weeks at a time. These are a simple chart, cash flow forecast versus P&L versus budget. So 13-week cash flow forecast literally covers 3 months. It's all about your actual cash in and out. And really, it's used to manage the liquidity of your business, which is what keeps you breathing. P&L statement is historical for a month or a quarter. It's based on accrual accounting. Each month you add the cost, you add the income on, and it gives you an idea of how to review your profitability for that period, 1 month or a quarter. And your budget, of course, is a projection for 12 months forward. Its basis is revenue and cost projections again, and you use that for strategic planning. But again, it is a document set for 12 months, and a long-range forecast is assumptions-based, and quite frankly, unless you've got a board of directors or investors to answer to, you won't be using them. So why do we do 13 weeks? The 13-week window isn't arbitrary. It corresponds to 1 quarter of the year. It's short enough for your projections to carry real confidence, and it's long enough for you to look ahead and anticipate problems before they become a real crisis. So really, it's close enough to be accurate, and it's long enough to be useful, and short enough that you actually pay attention to it. 12 months out is a guess. 13 weeks is really a plan. Now, why most business owners avoid this is really because they assume it's too complicated, or they assume that their books are too far behind, or they don't have time. I get it. You're running a business. But you know what? You can do one of these really, really quickly, and I'm going to show you how. I'm going to take you through it step by step in a minute. Bottom line is the businesses that I work with that are struggling most are usually not the ones with lowest revenue. They're often the ones that have got the least visibility of their finances. So building your 13-week cash flow projection, we're going to do it step by step. You don't need a finance degree. You don't need perfect QuickBooks or MyOb or any of those things. You don't even need a full-time bookkeeper to do this. You just need a spreadsheet, some honest estimates, and access to some bank statements in less than 90 minutes. The first one you do is you set up your framework, and that's literally open up a spreadsheet, whether it's Excel or Google Sheets, it doesn't matter. Create 13 columns across the top, one for each week. Down the left-hand side, create 4 sections: cash in, cash out, the difference, which is your net position, and a thing called your SAN, S-A-N-N, which I'll explain a little bit later on. That's the entire structure. It looks something like this. 13 weeks across the top, 4 sections down the side, cash flow in, cash flow out, dollars left, which is your net. Nice, simple, easy to do. Then you start with your opening balance. Week 1 starts with your current bank balance. So if you've got multiple accounts, add them all up. This is your starting point. Don't round up, don't fudge it, don't BS it, because your plan is only going to be as good as the baseline you start from. If you're not starting with honest figures, the whole thing becomes meaningless. Again, it looks like this. So in this case, there's 18 grand cash at bank. Nice, easy one. Step 3, project your cash flows. In other words, what do you expect to receive each week for the next 13 weeks? Include outstanding invoices that you've already sent that are due, but not yet paid, recurring revenue, retainers you get, or subscription repayments. If you've got monthly recurring revenue, break that down to weeks and put that in as well. Put down any pending deals that you're confident will close in the following week and any other deposits that you are reasonably expecting. Okay. The second part of step 3 is if your books are behind, pull up your last 90 days of bank statements. Look at what actually came in during that last 90 days and use that as your baseline instead of guessing. Then you just adjust for anything you know is different now. So if you know you did 10 grand the last 3 months, you do 3 weeks, whatever it is, put that in. Plus, you know there's more things coming in. You can adjust what you're doing. It won't be perfect, but it's going to be based in reality. And that's the key here. Just get a decent forecast, you have to base it in reality. So again, it will look something like this. The cash at bank, 18 grand. Sales are expecting week 1, 7 grand. 500 in retainers, 300 in subscriptions, pending deals, 3,000 other payments. So a total of 29 grand is expected to come in this particular week. Step 4, you project your cash outflows. In other words, what it's costing you to operate your business. Think of this in categories like payroll, including what you pay yourself, rent, mortgage payments, vendor and supplier payments, loan and line of credit payments, software subscriptions, recurring services that you use, your estimated BAS, everything else that you know is coming, like insurance, like car rego, like memberships. You should also be thinking about, again, if you're behind on your books, same move as before. Grab the last 3 months of bank statements. Look at what went out over the last 90 days. It's not perfect, but it's honest, but you can use that. So you'll end up with this. You'll end up in your cash out area. So rent, utilities, payroll, software, whatever it happens. So you expect $9,500 to go out in week 1 out of your cash flow. Step 5 is you just calculate your net cash position each week. And for the next week, that literally means subtract the total cash outflows from the total inflows. That gives you your ending balance. And your ending balance then becomes next week's starting balance. You do this for each of the 13 weeks. And when you've done that, you've actually got a cash flow projection for 3 months. So it just looks like this. We know what our cash came in. So with 29 grand coming in, what's coming out? 9,500, 29 minus 9.5, there are 19,500 left over. That's your balance there, which means the starting week, we'll be starting with 19,500 as our initial thing from there going forward. And you do that forward. So you'll see here 20,900 becomes the starting balance for week 3. 20,200 becomes the starting balance for week 4, and so on and so forth. So it's always this net figure here that becomes the starting balance for the next week. And then you add in what's coming in and you subtract what's going out to end up with a new net, which then becomes the start for the next one, moving forward from there. You've also got to find your danger zones. Once you've done this for 13 weeks, it will become apparent that you look over your 13-week projection and ask yourself, where does my cash balance go negative? Where does it dip below my minimum comfort level? Those weeks are your danger zones. So you don't necessarily have to have your cash go negative, but you might go, if I've got less than 10 grand in the bank starting the week, I'm really uncomfortable. So you identify those weeks, because that means if you see them now, you can start planning to do something about them. Seeing them when they arrive is too late, and that means you've got to fall into crisis mode. Quite frankly, if you're seeing the danger zone in advance, it lets you make that phone call, cancel that service, take action, sell more stuff, whatever it happens to be. When you see it the day it hits, it means you're scrabbling and you're going to be fighting bushfires. And that's not a good place to be running your business from. There's a lot of red on this. Don't worry about it too much at the moment under the sand numbers. But we can see here that there are 2 weeks where we are looking at there are going to be problems. So if I'm somewhere down week 1 or week 4 or even week 6, I can look at this. Because I've created this ahead of time, I can go, right, week 9, 9 weeks from today when I've created this thing, I've got a problem. So what can I do? How can I reduce my costs? How can I increase my sales? But I can take action ahead of time instead of just turning up and suddenly finding I'm behind the 8 ball. Does it meet your SAN? SAN means one thing, sleep at night number. It will be different for everyone. I try and teach my clients that ideally you've got 3 months worth of operating costs sitting in a separate bank account that you're not touching. And that should be your sleep at night number. But you choose the number. As I said, your number might be, if I've got 10 grand in the bank, I can sleep at night. It might be I need 50 grand, whatever it happens to be. I prefer to try and have 3 months operating as a minimum. 6 months is better. And 12 months is one of those things Alan was talking about. It's a unicorn almost, but 3 to 6 months is worthwhile. So if you're under your SAN, what do? Well, you look at how can I increase my income? How can I reduce my costs? That's it. So there's a lot of problems here saying if the SAN for this particular example is 90 grand and our net's 19,000, we're a lot behind it. So there's an awful lot of work to be done to meet the SAN number. But that's not unexpected when you're doing this for the first time. Because if you take the rule of thumb as being you should have 3 months worth of operating costs set aside, I can guarantee with maybe 1 or 2 exceptions in this room, no one's got 3 months operating set aside. So you're going to be behind it. But you can over 30. I know you're one of them, Jay. Yes, you should be too. But what it means is you're at least aware of it and you can start working towards fixing that issue. Step 8 is you should update it weekly. Yep, every single week. This is not a build it once and forget it tool. It's not shelf furniture. It's not something you just store electronically. You should have this printed out and stuck somewhere where you can see it, and you should revise it every single week. You should plan to spend 15 minutes a week going over it and making sure, seeing if there's any assumptions. Maybe you were expecting a deal to arrive this week and it's not going to arrive the next week. You can adjust your numbers, but you should look at it. Again, keeping an eye out for danger zones. As each week closes, you enter your actual numbers. So that document you've created, which is the forecast, as you get to the end of a week, you actually take your actual net number and use that for the following week and work forward from there. You adjust your future weeks based on what you now know, and the more consistently you update it, the more accurate it becomes, and the less likely you're flying behind. Here's a couple of tips. Be conservative on your cash inflows. Clients pay late, deals slip, and subscribers do churn. Plan for it. Be honest about your outflows. Think, what obligations have you been avoiding? Put them in. What things do you try and keep out of your finances that you've got to pay for anyway? The truth doesn't get better when you ignore it. You need to start refining from there. I don't know why that's popped up first, but never mind. Separate your business and personal finances. This is the biggest single issue I see with small business owners is they literally do not separate their personal and business finances. So they've got their business Visa card and they go down, they go shopping at Coles and it comes out of their business bank account. You must separate them. If they're still mixed, doing this 13-week cash flows is going to show it to you very, very quickly. Don't wait for perfect books. Messy books beat having no books at all. Use what you have, particularly bank statements. Label your estimates clearly, and then you can start refining from there. Look, the bottom line is We all started our businesses to build something: freedom, legacy, income, impact, a great lifestyle, whatever it is, or any number of those things. We built our business to get some of those things at least, but none of it happens if you're constantly surprised by cash crunches, if you're scrambling to make payments, you're behind on your BAS, or you're making decisions based on hope instead of data. The 13-week cash flow projection is not a glamorous tool. The thing is, it's an essential tool. It's not exciting, but it's the thing that keeps exciting parts alive in your business. Clarity is second only to structure in creating freedom, and that's what the cash flow forecast sheet gives you: clarity over what's happening. And let's be honest, freedom underlying it all is the whole point. So I'd ask you today, apply what you've seen, all right? You've still got time to get a plan in place for the next 13 weeks. You can create one anytime, but 13 weeks is it. Don't stick your head in the sand. Don't ignore it. And understand this: who's responsible for your success or otherwise? It's you. Simple as that. If you've got tools and you don't use them and the success is eluding you, then guess what? It's on your head. So help's available. If you'd like a hand setting one up or just talking through this in more detail, I will be in the breakout rooms, but also you can book a call. You can book a call with me. Let's have a chat about you and your business, not just about cash flow forecasts, which are boring to talk about, but essential to do. That's it. Any questions?
Okay, I'll just stop the recording here first of all.